all. A warm welcome to you all for second day of international webinar on contemporary issues in Commerce and Management 2020, organized by Department of Commerce, St. Philomena's College, Mysore. I, your host for this day, Ms. Malini B.M., Assistant Professor, Department of Commerce, Mysore. So today we have two sessions for this evening. Session 1, that is Climate Change, Issues and Challenges by Rodiger Kissel, and Session 2, Impact of the Pandemic to the Business Ecosystem, how various sectors have gotten affected, adapted, and thrived by Subrat Panda. So now I request Dr. Sunil D'Souza from Department of Commerce, St. Philomena's College, to introduce the speaker for first session of this evening.
Good evening, all participants. Good evening, Professor. I'm happy to introduce Professor Rodiger Kessel. Kessel heads the Chair for Energy Trading and Financial Services at the University of Duisburg-Essen. Previously, he has been Director of the Institute of Mathematical Finance at the University of Ulm. He also held position as a lecturer and reader for actuarial science and financial mathematics at Blackrock College, University of London, and London School of Economics, where he is still visiting professor. He is also a visiting professor at the Center of Applied Mathematics, Oslo University. His main research areas are currently risk management for power utility companies, design, and analysis of credit risk models, valuation and hedging of derivatives, methods of risk transfer and structuring of risk, and the stochastic modeling of financial markets using Levy-type processors. He is co-author of the Springer Finance monograph Risk Neutral Valuation and has written more than 60 published research papers. He is a frequent speaker at international conferences and organizing several practitioner seminars. Professor Kessel also consults financial institutions and regulators on risk management, derivative pricing models, and asset allocation. I always feel great that I work with him for a project and happy to say that he is my mentor and guide over the years. On behalf of St. Philomena's College, management, staff, and all students, a warm welcome to you, sir. Professor, now over to you.
All right, so thank you very much, Dr. Sunil, for this very, very nice introduction. I also remember very fondly the years we worked together and the visits I had in India and the visits you had in Germany, and how fruitful our collaboration has been. All right, so I'm now sharing my screen. So and I hope I can get the presentation. Yeah. Okay. If anything is not really working, please let me know. I think you have my screen now, right? So okay. What I want to talk for the next 45 minutes or so is the issue of climate change and the impact of climate change, especially on financial markets. So I want to give you a little overview on things that have happened in the last, say, 3 to 5 years, and some of the work we are doing currently in this direction. Well, the talk is more or less structured in the following way. I will give you a short motivation on things that are currently happening. Then we'll speak a little bit about carbon risk and investors. I discuss the issue of the carbon metrics and how to measure emissions and the carbon risk, and then I'll do a little overview on some topics that pop up in carbon risk analysis, and I'll spend some time explaining one of the projects we have, and I have a little conclusion and summary in the end. So whenever you have any questions or suggestions, feel free to interrupt me. I'm not seeing a chat or anything, so my good friend Sunil has to take over and stop me and then say something so that I can answer questions. Okay, so we all have. Okay, I think I admit this guy. We all have seen that climate change has become a much larger issue in the last 10 years, and not only with the emergence of Greta Thunberg and her strikes and her sort of speeches in front of world committees, but also before we had quite a few signs and reports that in terms of climate, we're moving in the wrong direction. And it took a while for the general public and for the policymakers to actually address the issue or recognize the issue as a pressing one. But by now we have a situation that, for instance, the World Economic Forum in 2020, for the first time, has listed climate risks as one of the, or as among the dominating risks in the survey of world decision makers. So environmental concerns dominate the long-term risks by likelihood of the World Economic Forum's multi-stakeholder community. And 3 of the top 5 risks by impact are environmental. And what's even more important, environmental risks are top in short and long-term risks in the ranking of the Global Shapers community, which is the younger community in the World Economic Forum. So it's more the forward-looking people. I have the slide, or I have the World Economic Risk Report Global Landscape, and the green ones are the environmental risks. So I shared the slides with Sunil, so he should have the set of slides. So I'm happy if he shares them later on with you. So let's see. So here you see extreme weather events are in the impact and likelihood are more or less the most feared risks. The failure of climate action, biodiversity loss, natural disaster, and human-made environmental disasters among the top 5 in that direction. Yeah. So it's clear that I mean that the risk of climate change has come basically mainstream, and the question is, what are we going to do about it? So let me go a little bit smaller here. The Science Advisory Group of the UN Climate Action Summit states in one of its documents in 2019, when they look at how the climate has changed, that the global average temperature for 2015 to 2019 will be very likely the warmest of any equivalent 5-year period. The 5 and the 10 and the 20-year warmest years have all come since 1995. So this is the 20 years, the 10 years since 1998. And the 5 warmest years have come in from 2010 on. The global sea level rise is accelerating from 3 to 4 millimeters per year. I think this particular problem for low-lying areas, as India has some exposure coastlines to that. We have increases in the CO2 concentration that continue to accelerate, and we have a growing climate probability. We have a growing probability that we will cross critical tipping points. Critical tipping points are points where the climate is changing in such a way that we do not have any reversal of this tipping point. One of the main examples is that the Gulf Stream might sort of change its directions, which would have devastating impact for Europe, because, as I say, the British Islands and Norwegian coastline, the Scandinavian coastline, all that benefit greatly from the Gulf Stream coming there. So it's a risk that urgently needs action being taken. Here's a picture of the global temperature anomalies, and what you see is a quick average of the worldwide, or a quick impression of the worldwide change of average temperatures. So anomalies from 1989 to 2010. I didn't find any newer slides. The progress has been made much stronger, and you see, especially in the North Pole area here, we have a much warmer, quite a lot temperature and anomalies. It's getting more and more hot, and you had this very sort of frightening use of Siberia having temperatures of 25 to 30 degrees, where we have this permafrost. And this also has other implication that methane might go out in the atmosphere and actually accelerate the warming of the globe. So the United Nations Framework Convention of Climate Change that has been founded quite a while ago, and during the first summit, has been sort of founded to facilitate intergovernmental negotiations on climate change, and nowadays it also supports implementation of agreement on climate measures such as the Kyoto Protocol and the Paris section. And it organizes this conference of party, which takes place annually, and it's the largest annual United Nations conference. So what is the problem when we face climate change? Well, the basic information is that we have overwhelming scientific evidence that the climate change is human-made, and we have basically 99% of all the papers, serious academic papers that say it's going to go in that direction. The cause of this climate change is the CO2 emission, or the greenhouse gas emissions. So the greenhouse gas is being emitted in the atmosphere, and the problem is it's going to stay there. So it's basically out there in the global atmosphere, and there is no sort of individual punishment for the emitter. It's a global problem. It most often happens as an externality in doing some economic activities, and this externality has not been priced so far. And the global society has sort of ways to price it, either as an emission trading system where you can have certificates which you trade in the best sense globally, or you have a tax system. And this conference of parties all the way try to come up with some negotiations with some solution to that. And one is the Kyoto Protocol, where the idea was that we would have an emission trading system worldwide. And the other is the Paris Agreement from 2015, where, because this emission trading system idea has not worked so fantastic, we have a sort of self-commitment of very many countries that they will reduce their emissions going out in the atmosphere. As I said before, the problem is that it's nothing you see immediately if you don't agree that the climate change, the global warming, is human-made. There is in some political minds irrational mind, so to say. No real need to do anything. And if one of the biggest emitters in the world isn't doing anything, isn't drive serious actions, the whole world has some sort of a problem. So we sort of had this global agreements, and the last one was a Paris Agreement, and it tries to bring all nations into a common cause to undertake these ambitions to combat climate change and to adapt effects. And the aim is to keep global temperatures rise this century well below 2, in best cases 1.5 degrees Celsius, and also strengthens the ability of affected countries to deal with the impact of climate change. So the measures is an appropriate financial flow, so that countries who are not so much affected will pay something to countries who are more affected, that we share technologies such as carbon capture, and that we have a great transparency or greater transparency of actions, which is done by individual countries. But I mean, you all observe the global political landscape, and we all know that all these aims are very difficult to achieve currently. But the Paris Agreement is now in force, as enough countries have agreed, committed to it, and so these countries at least should try to reach these goals. The European Union, the Parliament of the European Union has now proposed that they will reduce greenhouse gases by 60% to 2030 compared to the 1990 level, which is a very sort of ambitious aim. But the problem with the European Union Parliament is that it has no sort of political power. That all has been done by the individual member states themselves, and we have in Europe also quite a big discussion on what could and what should happen. Okay, let me go to these assessment reports. The assessment reports of the Intergovernmental Panel on Climate Change, the IPCC, is the science body who gives information on the research on climate change. So in principle, what they do is they write reports in which they summarize research that has been done. It's rather large reports, and they only refer to research that has been done. So there's no own research of this panel, but they give you a very good overview on the reports. They have 3 types of reports: on physical science, on regulatory issues, and further on. So in 2018, the IPCC has a special report on the impact of global warming of 1.5 degrees Celsius and possible other paths. We will come later on to the discussion of different scenarios on the financial markets, and the scenarios are most often taken from this special report. So here's a picture from the special report, and you see that this gray area is basically the area where we would end up with 1.5 degrees. There's other pathways which go higher and lower depending on the action we're going to take, and you see that this observed monthly global mean surface temperature is very volatile in here. Yeah, so if we reduce CO2 faster, then we might have a reduction below 1.5, and if we have no reduction, the probability of warming above 1.5 is very, very low. So we have some data that says if we do business as usual, the probability of staying below 1.5 is below 1%. And if you have a probability of more than 50% of a global warming larger than 3 degrees Celsius, which would be very devastating because we talk about average warming. Okay, so this was more the political science or the political side, the political issues, regulatory issues. What I want to talk about is more sort of the investment issues. So as we have, I mean, as I hope I have sort of pointed out a little bit, is there's a lot of effort needed to achieve this climate aims or the climate targets we have, and political finances or the governmental finances are far too low to achieve that. So the private sector needs to come in, and the private sector needs to recognize that there need to be done investments towards a greener economy. And the private sector has to support investments in environmental issues, but also it has to support firms which are more on a green side, so which are much more environmental friendly. And the basic sort of underlying idea of this talk is that we would look at how investors can treat this carbon risk, and how we can have financial flows going into the right direction. Okay, so let me go to these issues of investors. So as I said before, to reach the Paris target, we have to limit our further carbon dioxide emissions. And there is scientific evidence already since 2011 in a Nature paper that the major part of global reserves of fossil fuels can't be burned if we want to achieve this aim. So we're talking about 30 to 50% of known resources still buried in the ground of coal and gas and oil. So if we want to reach this aim, there's no need to get the stuff out. There's also no need to do anything in terms of fracking, because if we want to reach our 1.5 degrees aim, the coal and the gas and the oil business has to be sort of moved down very, very quickly. So if there's a regulatory change, then companies like BP or Shell, so the big oil companies who have a financial market value that is associated with their fossil fuel reserves and their assets, they are overvalued. They're overvalued because they cannot use these assets they have still in the ground. So the name of these assets is so-called stranded assets, which means you have invested in them, you have invested in finding these in the grounds, but now you cannot get them out. So they don't have value in your balance sheet. Also some infrastructure you have built, power plants or stuff, which cannot be run anymore, is also a stranded asset. So that means these companies are overvalued, and we talk about a carbon bubble here. Now, if there's regulatory pressure coming in, or hopefully pressure from the public side, they cannot use these assets anymore, so these companies are overvalued. So that will reduce the value of these companies, and it will also reduce the ability to repay their debt. So that now has an implication not only on the asset value, but also on financial markets, because now you have big companies who are not able to repay debt. And if you have that, then we run into something which would be similar to some sort of a credit crisis we had before, because some of the bigger private companies are not able to repay that debt. We saw something in that direction in the US already when the oil price was so low that fracking was no longer sort of profitable. Then some of these companies actually filed for failure, and we had some strange in the credit market in the US. Then they got some support, of course, from this president they have currently, and then the market sort of, and then these companies were able, with this government support, to be back in business. But it's an issue which could pop up, and there's already some research on that. So let me define carbon risk, the way we will use it, carbon risk reflects all the risks correlated with greenhouse gas emission. So you have this policy risk. If you're a company who has high carbon, high greenhouse gas emissions, and you have a tax, a carbon tax, then you probably have higher costs, and that's a risk for you. You have a market constraints. If sort of green energy is the energy that is used first, and you produce energy by coal or gas, then you have changes in the demand linked to the energy transition. And we had that in Germany. In Germany, we had coal and gas power plants, and some companies built these power plants. But then we had a regulatory framework which said, okay, gas from renewable energy, electricity from renewable energy has to be used first. And then this coal and gas power plants, especially the gas power plants, went out of business. You can have climate litigations, lawsuits to create liabilities due to emissions for targeted companies. So you could have somebody sue you because you emit too much. You can have investment regulatory frameworks. So you could have the regulator saying, okay, banks or other institutions may not be able to lend to some companies who are not green enough. You can have higher taxes on capital going in that direction. Currently, we have some schemes where you can get capital at a reduced interest in the European Union and in Germany if you convincingly claim that you do a green investment. And you have fiduciary duty regulated litigation. Institutional investors can sue you as a investment company if you not sort of are in line with the regulatory the regulatory limits or regulatory regulations, so to say. Okay, so you have all these issues. Now, if I'm a financial institution and I want to take this carbon issue seriously, I have several problems. First of all, we never have in this we have not been in these situations, and we actually have a forward-looking problem. So all we have is we have some simulations of the future where we have scenarios and things look very bleak in the faraway future. But there's some risk and uncertainty in that direction because we do not know what our scenarios say will actually happen, either on the good or on the bad side. We could have some new technology and which would capture carbon out of the atmosphere. We could do some other things. And then things wouldn't go as bad as they look like, but it could also be much worse. We have no historical data, obviously, for what will happen in this time of direction in the future. The climate forecasts are skewed and have fat tails. I said we have this sort of tipping point problem, so it could happen that we have, with very low probability, very great disasters in the future. So that's what I mean with fat tails. So there is a real small probability of devastating effects of that in the future. And then we have the time horizon problems. Financial actors usually think in 1 to 3 year terms, and climate risks materialize in a much longer term. Mark Carney, the former governor of the Bank of England, speaks of the tragedy of the horizon. So as I'm running a little bit tight on time, let me just mention these things. Investors realize that carbon risk has to be priced. And I have here a few examples where investment companies and firms claimed to go out of carbon risk. And there is public pressure, not only since Greta Thunberg, but even before, for investors to reduce their exposure to carbon risk. And Norway is a front runner in that direction. I have more of these examples here. I have a few headlines of Financial Times. In principle, what you can do is, I mean, you just pick up any of these more serious newspapers, and you find that this is really a topic, and you have more financial companies claiming to go along with that. So maybe use the example of Blackrock, the world's largest fund manager with 7 trillion assets under management, said it will double its sustainable focused exchange traded funds to 150. Well, I mean, sustainable focused exchange trading funds are very popular by investors, so that's more or less a little sort of publicity gimmick. But they also said they will cut companies that derive a quarter or more of their revenues from thermal coal from its activity in their portfolios. This is from January, and they are now under pressure because they haven't done enough in that direction. Many companies, that's the last bullet points, many companies try to play very green now, but they do what we call greenwashing, which is saying that they're green, but in the end they are not green. And I'm very sorry to say that the extreme example, in my point of view, is Volkswagen, the German car maker, who portray itself as green, and they were cheating on emission tests. And so I never could believe that German engineers would cheat on this kind of tests, but apparently they did it, and they did it in a big way. And now they sort of act as if they invented electrical cars here in Germany. So it's a very, very sad thing to say, but we'll get them on the right track soon. Okay, then another problem or another issue I want to mention is the carbon metrics. So how do we measure emissions? So a growing number of governments, companies, investors disclose a carbon footprint of their activities. So carbon footprint is, in principle, I come to it, CO2 emissions in a certain way. However, that's backward-looking disclosure. So we should have some data on what they will do in the future, what are the forward-looking aspects of that is. Currently, the appropriate metric is unresolved. So how should you normalize the carbon footprint, and what are the numbers actually that, what do the numbers tell you that you see? You have different methodologies, and you have different carbon metrics, and the companies are not fully comparable. So maybe at that point, I sort of tell you quickly what I'm after. So we want to try to assess the carbon risk of companies in basically every hour sort of research ideas we have. So we need to get a measure for that. And we're currently in the process of collecting data in a worldwide database on all these companies. And it's very, very hard to sort out what actually their emissions are and what their forward-looking sort of ideas are. It's a very sort of time-consuming sort of job to get that. And some of the numbers we have, and I'll show you some in a little while, have to be sort of treated as a first try, and we need to be much more precise in that. But I'll come to that. So the carbon footprint, the so-called carbon footprint, so the CO2 emissions, is currently the most widely accepted concept. It's also being sort of championed by the Carbon Disclosure Project. This is it has been a private organization which was writing at big companies and asking them to disclose their carbon emissions, and that then I mean went into some research projects. Okay, this carbon footprint or these emissions are divided into 3 scopes. So we have scope 1. These are the emissions which are direct from company vehicles and energy use in factories. You have scope 2 emissions, which are upstream emissions coming from the purchase of electricity, heating, and coal of some of the firms. And then you have scope 3 emissions that are indirect and sort of are the emissions that come from the supply chain or from how your sold products are disposed or what franchises you have. And if you look at this, you see if I have scope 1 emissions, well, maybe we can sort of measure them in a quite appropriate way. Scope 2 emissions may be already a little bit more difficult because, I mean, you purchase electricity, but electricity emissions depend a little bit on the generation of this electricity, same as heating. And scope 3 is even more complicated. You might have some double counting or not counting, and so it's a very difficult and complicated issue. Okay, let me skip this one because how to aggregate on a portfolio level, I'm not coming back to that later on. It basically tells you if I'm an investment manager and I want to be responsible for the emissions of my portfolio, I typically would sort of look at not the absolute emissions, because then I couldn't take some of the bigger companies into my portfolio. I would do some sort of normalizing in terms of sales of the company I have or in terms of the weight this company has in my portfolio. But let me skip that because I want to tell you something about our own research or some of the research I find particularly interesting. So let's look at the carbon risk analysis and let's look at something a Blackrock group has done, and it's on physical risks. And it's the link to what we are doing is the impact on this physical risk on municipal bonds. Municipal bonds are bonds that the big cities in the US can buy or can sort of sell, finance themselves from this bonds and have to repay them. And they use that to finance some infrastructure or basically all that's going around in these cities. So what can happen to that if we have if we look at physical risk? With physical risk, I mean extreme weathers, I mean heat periods, I mean hurricanes and these kind of things. So if you a city, say you're Miami in the US, and a hurricane hits you, you have extra spending on the cost of cleanups, on projects that will protect you for rising sea levels or extreme weather. And of course, if you have some buildings there, you will have to pay higher insurance premiums. But what also will happen is that some of the population whose houses, say, have been destroyed will relocate somewhere else. Also, if you have a danger of this physical destroying of property, your property will not be as worth as much as it has been before, which will have an effect on tax. So maybe some of the businesses you have in your area will sort of leave the area. And so the revenue or the bond, so your financing of the bond will be in danger if these events happen. And this Blackrock analysis has generated a map of the US where you have where you see states and areas which will see a net loss or a net gain in terms of changing weather. And loss is the brownish ones, gain is the greenish ones, and you see brown dominates by far here. Yeah, and they also had now this is sort of one of the scenario analysis going in the future. They also had the GDP loss related to 2020 in further years. Yeah, and you see you have in the worst scenarios, you have 3% or more loss for almost 40% of the cities or the municipals you have around. Here's the cities most at risk from that are Miami, Dallas, and Houston, and most of them are on risk. So this basically says there is a risk on the municipal bond market, which is rather large in the US from these extreme weather events. But when they sort of looked at the change in prices of these municipal bonds, they saw after extreme events, they saw only sort of a short-term effect on that. So it seems that climate risk is not really priced, or this type of risk is not really priced in the municipal bonds. You would expect that you have a much higher premium, a much lower price on the bond traded here than you have in one of the more greenish areas. Okay, let me skip a summary of 2 more research papers, and then I want to tell you something we're currently doing. So it's a bit of my own research. And as Dr. Sunil said so kindly before, I have been working on a financial mathematics institute, and one of the issues we were looking there was how credit risk is traded and how the financial markets treat credit risk. So we were looking at credit default swaps at that time, and now we came back to look at that in terms of climate risk. So credit default swaps is basically an instrument with which you can insure yourself against a default. So it's an insurance against default. And this insurance has a premium, which we call the credit default spread, or the CDS spreads. And they reflect the market view on the firm's credit risk. And you can sort of, you have credit default swaps traded for most of the bigger companies around. And so our idea was, if climate change carbon risk is a risk that the financial markets treat serious, then we must see a difference in the credit default swap spreads for, say, brown and green firms. So brown firms are firms which have a high carbon risk. They basically produce a lot of CO2, and green firms have lower green gas emissions, and they also go sort of forward-looking in a more greener direction. So our question was, do these carbon risks affect the CDS spreads? And for this slides I'm showing you, we had 133 major European firms. We now increasing our environment substantially. We actually moved to the US, and we have in the order of 500 US firms we're looking at. We look at, but this is just the European one, but it's no difference in the US, I would say, from what I have seen in our preliminary analysis so far. So we look at different maturities of the spread. So 1-year insurance, a 3, 5, or 10-year insurance, and we have data from 2013 to 2018. We know from previous research that the credit spreads are affected by stock price and stock price volatility, and from the credit rating the firms have. And we will introduce as an additional variable some variable which has something to do with the environmental score these companies have. For that, we construct what we call a carbon index. So the carbon index basically is something where we say, okay, we divide our portfolio, our 133 firms, in principle, some who are higher emitting and some who are not so high emitting. And the ones we call high emitting is what we call brown, and the ones which we have low emitting is that we call green. And The index is basically a portfolio where we go long the green ones and short the brown ones. Yeah, we not use all the green ones and brown ones. We just use tercentiles of greens and brown ones. So we basically construct a portfolio, and the portfolio is basically green versus brown. Yeah, what we see is our carbon factor now, because we have green minus brown, so we have a negative carbon, a negative spread. So that already indicates that brown firms have a higher credit risk than green firms. And it also reacts to, let's say, this is the blue one is a 10-year spread. It also reacts to the political events in the right way. Yeah, we had a much higher spread during the Paris Agreement. So then the brown firms needed to pay a higher credit spread. And when good old Donald came into power, we had a little jump in the other direction, where we see that we have a sort of movement that the creditworthiness of brown firms compared to green firms improved a little bit. Okay, so this is what I said. Our first exercise was that we were sort of doing a histogram of what the spread was for green and brown firms. So you see for the 1-year spreads that the brown firms have a higher tail, but on average they sort of look the same. But the picture changes if we have a higher maturity. So the higher the maturity, the more risky the brown firms are sort of viewed in the market. They have to pay a much higher credit spread than the green firms. Yeah, so this points already as evidence in the right direction. But then we were doing some empirical asset pricing exercise. In principle, we did a regression and a tail regression with that. We built on a paper that is the basic factor analysis. So this paper from 2014 in the Journal of Banking and Finance says that stock return, stock volatility, and the market condition are the most important covariates to measure credit spreads. Stock returns and stock volatility are no surprise, because that comes from the sort of basic Merton model. And the market condition they measure as the median sort of change in the credit rating index these firms have. So it basically takes care of a market situation where all firms together, whether they are green or brown, are worse rated because of something happened globally, or at least in the stock market. Yeah. So and we added to the model our as a variable our change in carbon index. So we have a regression where we look at the change in CDS spreads, and the regressors are the stock return, the volatility, and the median rated index. And in addition, we had the change in the carbon index. Okay, so this is the equations. Let me go to the table, and let me go, because I think I'm running more or less out of time. Let me go to the most important results. So basically our analysis confirms that stock return, volatility, and this median rating are important, but we see that the carbon index is an additional factor, and it comes negative into play, which is sort of the right sign. Yeah, so if you're a brown firm, then this change in carbon index affects you more, and it's becoming more significant, so to say, the longer the maturity is. So we have some term structure of maturity effect here. For 3 years, it is significant on a 5% level, I think. No, it's or on a 1% level, and for 5 and 10 years, it's already significant on a 0.1% level. So it's I mean, a result that very much confirms that the climate issue has an impact on the creditworthiness of companies on the financial market. We looked in a little bit more detail in doing a quantile panel regression, where basically you look at the different quantiles of the firm. So you look at the 10% best, the 20% best, and then the 90, and then the worst. And the results actually say, okay, there is heterogeneity in your climate change affectedness. I show you the picture here, in as much that if you're sort of in the middle of the group, the way you're affected by climate change is slightly different if you sort of a very green or if you're a very brown firm. Yeah? So you have a difference in that, which is also very interesting, and we hope to confirm that in our sort of larger exercise, or we'll do even for the US. Okay, I think I skipped the last slides. This is the informational network on greening the financial system. This is another project we're going to do, and this basically says the Bank of England said we need to have stress tests for banks, and we work on designing such stress tests. Basically, that will say, okay, if you're a bank, you have to take climate change seriously. You have to look at your portfolio. If your portfolio has many brown firms, there might be a chance that your debt lending will get into trouble. So you should have extra capital set aside in order to be working as a bank. And but the way in which this risk weights are given and in which this carbon risk is measured is still unclear, and there's still a lot of research going on. So it's a sort of very interesting type of topic, and as this is a global topic, we already had early tries to do similar research for the Indian capital market and for the Indian debt market, and there's interesting papers out there. So I hope that we'll find also some opportunity and locations where we can work together in this direction. So let me just conclude. Climate change and carbon risks are very important for financial markets, and it will gain further importance. This dynamic is here. The classification of companies with respect to their exposure is very data intensive. It's high dimensional statistical methods that you need to use, and in order to sort of get this carbon metrics and analyze these companies. So it's a machine learning issues, and we work also in that direction. We see that carbon risk affects the credit spread, so the default risk of companies, and we work on stress tests for bank credit and portfolios. Well, so I hope this was helpful to you. Here is my possibilities to connect to me. Feel free to do so on the webpage. There's also the email address. So I'm very happy to interact with you further on and after this talk. But now I'm happy to take any questions. Okay, so yeah. I hope I don't have to do anything more.
Yes, fine, sir. Okay, we have few questions. I think my friend Sandesh will raise that questions. Okay. Yes. Yeah, Professor, can you hear me?
Yeah, I can hear you well. Yeah.
Okay, fine. Professor, there are some questions from participants. That is, what is Paris Summit and how it influence developed and developing countries? Any comparison? That is.
Okay, well, the Paris Summit in 2015 was this conference of party meeting, which takes place every year, where basically all countries, including developing countries, discuss how climate change can be sort of slowed down or even reverted. So it's basically all countries sit on the table and discuss measures, which makes it very, very complicated. You know, the negotiations are very complicated. And of course, developing countries have different points of their agenda than, say, the Western countries or the US. I mean, one of the issues, of course, is if greenhouse gas emissions, CO2 emissions, is something which I don't know whether I can do that, is something that is sort of put in the atmosphere for years and years and years. Could we not have a point of view that every country has a share of this sort of carbon sink in the atmosphere, and the more developed countries have already used most of their share. So what we would have now is that the developing countries can use their share and not the most developed countries. So issues like that sort of pop up. But I think a better way is, and this is now being put forward to say, okay, the more developed countries have used fossil fuels for their further development. So why don't we sort of skip that phase? Yeah, we're now in more environment-friendly energies. Why don't we skip that phase for developing countries and say, okay, you should try to use renewable energies now in a much greater extent and not use this phase going through fossil fuels before. Yeah? And for that, some financial support from the more developed countries should be given, and then this is also on the Paris agenda. So the Paris agreement was a very important agreement, but you probably know that the US is going to go out of it unless we have a change in leadership yeah. So, but that is one of the problems we have with this international negotiations. Yeah, but the European Union is committed very much, and also China. And I didn't actually check in which direction India is going, but I think India is also doing very well in that direction and committed itself.
Yes. Professor, one more question that is from Manoj Lewis. He asked, don't you think carbon credit is reduced during this lockdown period? So for COVID-19, they went for lockdown, and how the situation across the world? That is the question.
Yeah, it has been reduced, obviously, because there was not so much movement. Planes were down, but it more or less shows us that we can that we can sort of live without too high emissions. Yeah? But the point is that. I mean, the data now show that the reduction was not so much, so it's going to pick up right now, and we have a lot of carbon in the atmosphere already. So because it has this sort of sink effect. Yeah, when we emit carbon, it stays there for 50 to 60 years or even longer. So the emission we done years and years ago are still in the atmosphere, and as long as we don't have a method to get carbon out of the atmosphere I mean, trees and plants, they are carbon sinks, they get carbon out of the atmosphere. That's true, but it's a very slow process. You know? So in order to prevent this climate change with its worst effects, that has to be quick or fast. So what I'm trying to say is we see a reduction during the COVID crisis now. But it was only a little dip. It picked up now. It picked up already again. I don't know what's going to happen in Europe. We have very sort of we don't have a good development in terms of COVID here. We see increasing cases already all across Europe now coming up. So but the consensus is that industry should sort of go on working, even if we have some milder form of a lockdown coming up. And I don't think we have a long-lasting effect on carbon.
Okay, great. Connected to that, you are saying developing countries are their developing countries, and we are going for these carbon emission. But when you see the solar project and the thermal or coal project, if you compare these two, so most of the countries they prefer coal or thermal because it is a less costly compared to solar or wind power project. So how we can go ahead with that?
Yeah. Well, this is something we were looking at a few years ago together already.
Yes,
How could environmental energy projects be supported? At that point, we had this carbon credits in terms of the European Union, and our research was looking in voluntary credits and institutional credits at that point in time. And what we found was what the world community found out later, namely that they didn't work so well. So what's happening now is that in terms of the Paris Agreement, we have this financial aspect. So the world community, the more developed countries, should provide some finance in order to make it more attractive for the less developed countries to put solar panels up there instead of coal. But I mean, it's in Germany it's the same problem. So I mean, companies want to earn some money, and power plants by coal are in principle cheaper than putting up windmills or solar panels. So we don't have as much sun, unfortunately, or fortunately. But I mean, I think your point is right, and this is one issue this Conference of Parties should tackle, namely this financing of renewable energy and putting more green finance in there. But the Paris Agreement, the Paris Agreement has a feature on that. There's a green bank, which is precisely sort of doing that, and so there is some hope, that we go in that direction, and we have some sort of micro projects. For instance, I at one point read about a project where you will have individual solar panels, very small ones, which families could use for the houses. And then instead of, and then batteries. So instead of then having to heat through the night with wood or anything else, you could have the solar panel and then the battery, and then you could have a very easy and affordable sort of heating. So this technology is already available on a micro scale, and it should be sort of rolled out much more in countries where it's necessary.
Okay, great. Okay, yes. So, Professor, there is one more question. They are asking your opinion on United States. They pulled out of Paris Climate Summit. So, what is your opinion?
Oh, how much time do you have? So
only two. Yeah, this is the last question.
Yeah. Oh, I mean the short answer is of course another example of a very bad leadership. Yeah. So I mean the US should take over some leadership there, or I mean we can do without them. Yeah, we can. I mean, India, China, the European Union. It's big players out there, but of course, globally seen, the US is one of the leading actors in that direction. So it has been it is very bad because it sort of re-emphasizes this. Whatever country first approach that we unfortunately have. So as a world community, we should work much closer together. And I mean, we all have different interests, that's clear. But I think we can find a solution if we negotiate with each other in an appropriate way. Yeah. So the US also has sort of counties or states which are very green, like California. They have a trading system in place. The East Coast has a trading system in place, emission trading system. They're reducing their carbon quite dramatically. Unfortunately, they have to fight a government that does, in my opinion, the wrong things at the wrong time. But I mean, there is some hope that we go forward, and we can do that. We can get.
We
it.
have to wait for next election, I feel.
Yeah.
Yes.
All right.
Yeah, great, Professor. Thank you for your brief answer for all the questions which is asked by participants, and thank you from the management side, St. Philomena's College, Mysore, and I hope that we are going to meet again. That is not virtual one. Physically, we are going to gather, and maybe we'll see and look forward for the different projects.
Yeah, right. No. Thank you for having me. It was a pleasure, but an even greater pleasure would be to meet in person. You're right, whether it is in Germany or India. So take care, all of you, and best wishes.
Thank you, Professor.
Thank you.
Thank you very much. Okay.
Dear participants, welcome back to the next session. So now the second session, impact of pandemic to the business ecosystem, how various sectors have gotten affected, adapted, and thrived. So now I request Dr. Oshma Roslet Pinto, Head of Department, Department of Commerce, PG, to introduce the speaker for the session.
Mr. Subrat Panda did his BTech honors from College of Engineering and Technology from Bhubaneswar and PGDM from XLRI Jamshedpur. He has over 17 years of experience in investment banking. At present, he is the Director of Investment Banking, Motilal Oswal Investments Advisors Limited outside Mumbai. He had worked for equity transactions in financial services that includes public offerings of Indostar worth rupees 18 billion, MAS Financials rupees 6 billion, OSFB rupees 19 billion, Avenue Supermarts rupees 19 billion, BSC rupees 12 billion, REC Limited IPO worth rupees 16 billion, Union Bank of India FPO rupees 8 billion, and Andhra Bank FPO worth rupees 8 billion. Qualified institutional placements of S Bank for the year 2019 rupees 19 billion, HDFC Bank rupees 28 billion, HDFC Limited rupees 71 billion, L&T Finance Holding rupees 10 billion, and Piramal CCD rupees 50 billion. Further, he was a part of advisory mandates in financial services that include State Bank Group capital requirement, evaluation, and fundraising options, advisory SBI medium term note program advisory transactions for the acquisitions of stakes in UTI AMC by T. Rowe Price and in LICMF by Nomura Asset Management. He was a core member of the team that set up the online services of State Bank of India. Over to you, sir.
Thank you, madam. Thank you for the kind words. And just to quickly, can I share my screen?
Yes, sir.
Yes. Give me 30 seconds, please. So once again, thank you very much for hosting me for this event. So as all of us are going through a global pandemic, and it is very interesting to know how it has impacted business at large, and the way this talk is going to dwell upon is basically within the economic ecosystem. There will be a lot of subsectors, and how this specific situation has impacted those various subsectors, right? So that is the background. The way we can go about it is simple. Uh, Let me take you through the slides. At any point in time, if you have any queries, do stop. You can please kind of go ahead and ask your questions. Or if you would want to wait it out till the end, that is also absolutely okay with me. So having said that, let me use this disclaimer. Um, these are my personal opinions and probably not a reflection of what Motilal Oswal Financial Services as a group would want to provide. Maybe a lot of our thought processes as a group versus as an individual may be aligned. But having said that, this is not an official view of Motilal Oswal, and that's where it is. And a lot of these slides we would have picked up information and charts and some of these anecdotes from a lot of sources, including some of these global statistical organizations like the IMF, World Bank, some of our internal research reports, and some of the interesting reports that I would have come across from the McKinsey's, BCGs of the world. And I'm sure none of us uh, on January 1st, 2020 would have assumed this is how we are going to meet, right? So this is just a pictorial description of how 2020 has been for us, as in most of 2020 has been for us. So we'll quickly dive into the agenda. So let us quickly understand what is this pandemic, how has it been in India per se, and what are the impacts that we see in the Indian businesses, who has suffered a lot, what kind of businesses have kind of adapted themselves to take advantage or kind of thrive around the current ecosystem, the lockdown, changing their business models, etc. And then where do you think we are headed in the next few months, few quarters, and so on and so forth. And obviously, again, as in at any point in time, as in while I have put it in the end, but any point in time you would have any queries, please do stop by and ask your questions. Right. So this is considered a black swan event. So 2008 global financial crisis was the last black swan event that we had assumed. Then closer home, maybe around late 2018, we had another black swan event specific to the Indian ecosystem. That was the ILFS rating crashing to a default rating, and the ripples that it caused in the Indian markets and the Indian economy at large. So what's the change this time? So the change is it's a black swan with a face mask. Yeah. So I am sure a lot of us by default have started using the face mask and very frequent washing of our hands, etc., etc., as a part of our lifestyle and hygiene. And do you think it's going to continue? I'm sure it is going to continue. Yeah. So what were we thinking? So this is a slide which kind of compares what kind of search engine queries that were put up, okay, prior to COVID. So somewhere around Jan 2020, and some of the important keywords that were the top most searched items were the Avengers Endgame, the World Cup cricket, which never happened, the iPhone 11, which obviously came through and has been a success, Stranger Thing, and Game of Thrones. So of these, can you point out what is the key trend of all the, or rather the key theme around all of these? I think all of them are aspirational, right? And all of them are around entertainment, or maybe as you would call it, discretionary spending of either our time or efforts or money, right? None of these things are important for us to survive or to go about our day-to-day businesses. So how did it change somewhere around April 2020? I think around mid-March to about late March, most of the offices and probably the government notifications had arrived around the lockdown. So as soon as the lockdown hit somewhere around April 2020, the key search words changed to a COVID, income loss, a job insecurity, sanitizers per se, how to reduce expenses, the COVID-19 vaccines, What does isolation ward mean, and obviously what are the statistics around the number of active cases, number of dead people because of COVID-19, etc. Suddenly the shift of emotions, just have a look at the shift of emotions, as in I would assume most of them would be on a negative side, right? As in you are always clouded by a lot of doubt, by a lot of apprehension, and a lot of how do you put it, insecurity around going about things, right? So this very clearly indicates how quickly the mood changed from being an optimistic, uh, go, as in happy-go-lucky kind of a situation that we were in January, and within 3 months, it immediately shifted to a slightly more somber mood, and this absolutely started impacting. As in one of the barometers of an economic performance, it is said, is the stock market performance. And you remember how badly stock markets kind of corrected somewhere around end March, right? So with this, let us see what exactly had happened across the globe. Uh, so if you would look up on the left hand side, it is a clear indication of the number of cases that people started reporting around the globe uh, about the COVID cases, and how it kind of matched up with the maybe let's say the MSCI global index, right? And you can see how badly that white line kind of fell down by as much as maybe around 35-40% bips, and then maybe at about April it was around minus 23%. But then what happened? What happened at that point in time is globally, macroeconomically, the world banks, or rather the central banks across the globe, started responding to this crisis through their monetary policies and through their other mechanisms that they had with them. And if you can quickly look at how the rates, or rather the, as in a proxy of which is a 10-year bond yield, as you would have already studied in your classrooms, you can quickly see how the quantitative easing kind of, in a way, slightly tempered down where the 10-year bond yields were, right? And this was just the beginning of some of these quantitative easing measures. Over March till about September, you would have seen multiple rounds of stimulus packages, quantitative easing of various coordinated quantitative easing across the globe. Each of the major G7 countries and a lot of the wider countries per se had started creating some financial package or the other to kind of support their local economies, right? Uh, so this in a way brings us to the point where we should understand how come a pandemic can kind of impact the slowdown, and how did it kind of fructify. I think the first thing that the globe saw somewhere around late January, which was the Chinese New Year, around probably the third week of January was when the Chinese New Year was, and that is where the impact of COVID was seen to be the highest in China. And it also kind of saw a simultaneous lockdown of the Chinese manufacturing plants, right? And China at that point in time, even today, is one of the largest manufacturers for the globe. Um, even if I'm not trying being generic, even today, even if you move out of China, this manufacturing standstill was the first leg. Okay, as in even in India, you would have seen when the lockdown got announced, you saw a lot of lockdowns and a lot of people trying to move back to their houses, a lot of factories getting shut. Maybe you can say that not only the larger plants, some of the larger plants were still operating, but a lot of these small and medium enterprises who depended on their small time manufacturing setups, those were kind of shut down, right? And once that happened, if you remember, everyone is a part of a value chain, right? So when you step up from one one process to the other, and one of the legs is has broken up. So that led to a lot of supply chain disruption. So that kind of started being visible, let's say the auto component space, maybe around a lot of infrastructure elements, etc., etc. So this was leg two, the supply chain disruptions, right? Then came the part three of it, which was the cash flows started getting blocked. So when you did not have enough sales, or whatever inventory that you had at whatever point in time, those were already kind of either sold or they were not moving at all in the first place, you did not see the cash registers ringing anymore. What did it imply? Which basically implied that there are no revenues, but there are a lot of fixed costs, and maybe a fixed cost in terms of rentals. Let's take, for example, a mall, right? So if a mall is shut down, there are a lot of small stores within those malls, and there are a lot of housekeeping fellows within those malls, right? The mall still kind of required some amount of manpower to run them, but there were no revenues for those malls, right? So that cash flow blockages that happened, that as in basically culminated in this entire economy to kind of come to a standstill, and that is why I call the juggernaut break, right? So I hope I have been clear around how each of these legs have operated. If you have any queries here, we can probably stop by, or I can move to the next one. Okay, let me get going. So this is just to kind of again highlight the sense of optimism that we had around the GDP forecasts across some of these larger advanced and emerging markets, and that is what you would see at the bottom and the light blue line, and the average, which is probably a mid shade of blue, right? So one of the key highlights of this chart, if you see, is that advanced economies were always assumed to be growing slower than the emerging economies, primarily for various reasons. One of them being the emerging economies by themselves, where the manufacturing, or rather the services and product suppliers to the globe, and they also had a lot of domestic consumption. If you look at China, India, even Russia, Brazil, as rather what they call as the BRICS, as in these also have a very strong domestic economy around them. Less so with Russia because of the commodities, the oil being their major commodity basis, which that economy sustains around. But having said that, at least some of these larger economies were expected to kind of catch up faster, would react lesser to this pandemic situation and then catch up, right? Maybe the indications were probably as a whole, the emerging economies will probably catch up and probably reach a 7% growth rate by the end of 2021. Mind you, these are all calendar years, which is what most of this IMF and World Bank data operate on. But then what actually happened in India as a projection, what you would see India. So compare this in 2020, the entire emerging market pack had moved to a -1, whereas as against that, India was expected to probably be at a 1.9 positive by FY 2020, and then expected to grow back at the rate of 7.4% per annum GDP growth. As per IMF, and this is probably somewhere around March of 2020. What happened when April approached? So if you look to the left-hand side of the chart, if you look at some of these numbers, you started seeing Canada, UK, US falling much farther than what they were expected. China was still positive. India was still expected to be positive till the official data came out to be about maybe somewhere around in the range of -20, right? But the key highlight here is if you look at the entire snapshot of these countries, the only two countries which were supposed to be performing better than the rest of the globe were India and China, all right? And at that point in time, this is what actually happened. So if you look at the bottom half of the chart, you actually start seeing the actual performance of some of these larger economies and a lot of these Asian economies. India grew, probably the India's numbers were probably one of the most weaker numbers that we saw. And till that point in time, and even today, if you have heard the policymakers of India, the tussle has always been between saving a life versus saving the economy per se. So what I call it as the tussle between G1 and Jivika, right? And so around March and April, you saw some of these industry leaders speak about the current state of affairs of the economy as seen from the lens of a societal angle, right? So Adar Poonawalla, as you'd already know, is one of the pioneers in the Indian vaccination space. Economic danger of the pandemic outbreak was exponentially greater than its health risks. So this is his thought around the impact that the pandemic had on the economy versus what it was expected to have on the health infrastructure and the ecosystem around that. Mr. Narayan Murthy, again, as you would be extremely aware of who he is, needs no introduction. Somewhere around April 2020, said these words: India may see more deaths from hunger, I'm sorry for the typo, from hunger than from the pandemic. So this in a way shifted the outlook from COVID being a health scare to COVID being a anthropological scare, or maybe a social scare, as in the way for a country like India, which had very limited amount of social security infrastructure in place, we started seeing a lot of impact to livelihoods per se, especially around the bottom of the pyramid livelihoods and a lot of the mid-income livelihoods, right? So, and most of us would have experienced it maybe directly or indirectly through our day-to-day movements around the city, or maybe through news channels, or maybe through various other mechanisms, right? Or maybe some of you who were probably in Mysore in your classroom wanted to go back to your respective houses now that the lockdown was implemented. You saw how easy or difficult it was to get back, and then depending upon where you were and how well prepared you were prior to this lockdown happening. So having said that, let's move to the next section, which is what is called as the new normal. So what is this new normal? So you have seen lockdowns and then some of these unlockdowns, right? And unlockdowns started coming with their own set of rules, started coming with their own not only hygiene parameters, but how you are supposed to conduct business, how you are supposed to conduct yourself in society, etc. So in a way, no one is aware even today, as in what is going to be the new normal. How can we as a society adapt to the new normal and go about our daily routine? How do we go about our businesses? How do we go about our livelihoods? How do we go about our, maybe, how do you put it, as in what was normal for us last Christmas may not be the same this Christmas, or maybe the last Diwali versus this Diwali, or maybe the last Dasara to this Dasara, right? So so the idea is there is a little bit of uncertainty, and the idea of taking care of the uncertainty, how we are able to plan it, how we are able to kind of take uncertainty along with us and go about conducting our business will depend as to how quickly we can recover from this. So just to quickly, on a lighter note, how it has impacted our classrooms. So did you ever assume that you need not be in a classroom setup to be having exposure to such kind of events, right? So yesterday you had two great people speaking to you. Today you have me and a lot of other people who would have spoken with you. And this is something which will continue. And I'm sure a lot of you would have now kind of gotten accustomed around Zoom, around Meet. A lot of it were probably non-existent in your mobile phones or in your laptops as late as March of 2020, right? So what I'm trying to say is this has become the new normal, and we are now very much used to it, as in this is something which has become a routine for us, right? So then let us quickly see how this machine generally works. As in, at this point in time, probably if any of you is would want to kind of interact, as in maybe, can I pose you a question? As in, can you explain to me a normal day for you uh, somewhere around, let's say, last Diwali, right? So if anyone would want to volunteer as to how did your day go the previous Diwali? How did you go about your previous Diwali day celebrations? Anyone would want to share?
Sir,
Yeah.
I think most of the, we are doing YouTube live stream, so most of the participants are in live.
Oh, okay, fine.
So it is
no problem. So maybe let me take anecdotal evidence or maybe an anecdotal case study of any general person's life, right? So take any day per se, right? So maybe I'm just using Diwali because a lot of positive emotions are attached to it for a lot of us. Maybe in a Bombay kind of a setup, in a Mumbai kind of a setup, uh, you always end up buying new sets of clothes. Maybe you kind of get your house cleaned up, maybe painted. Maybe you give out bonuses to your domestic helps drivers. Maybe you receive and exchange gifts with a lot of your friends and family, right? And maybe you end up cooking some real good delicacies around at home, maybe sweet meats, etc., right? So look at it this way from a financial perspective, right? So new clothes, you have gone out and shopped a lot. Maybe for the entire family, you may have visited twice or thrice some of these larger malls. And when you visited these malls to buy clothes, you may have also ended up eating at the food court, etc. Maybe when you are giving out bonuses to your maids and domestic helps and drivers, they would use that money to go and spend. Probably you would have bought how do you put it, decorative lights. Maybe you would have hired painters to kind of spruce up your walls, right? So look at it as in there are various elements around your spending in around an event. Having said that, even on a normal day, when you step out of the house, you go and get into a taxi or you go and get into a normal bus, go to your place of study or your place of work, maybe chit chat with your friends, okay, and probably have lunch either at the canteen or you order out food. Maybe towards the evening, you visit a restaurant and have probably a quick snack or whatever it is, or probably you go and watch a movie and then come back. Maybe if it is too late in the evening, you again take back a taxi and come back home. As in, just this is anecdotal. Maybe this is true in Mumbai, but in Mysore, you probably would be using bikes. So just to kind of give you an anecdote as to what happens, right? So today, I do not know how many of us have stepped out of our houses for at least going to a mall, going to the mall to purchase something. Maybe it is a apparel, maybe it is a shoe, maybe it is a tie, maybe it is any domestic item. I do not think many of us would have moved. I'm sure a lot of us have started ordering in food rather than visiting a restaurant, right? I'm sure none of us have visited a movie theater at all, right? So look at it as in on a day-to-day basis, you would also realize how important your spending was for the economy and what is called as a money multiplier, right? So a lot of you would have come across this concept in probably Economics 101 about the money multiplier. So this is exactly what the situation is on the left-hand side, right? Now expand the scope from you being an individual to you being an economy at large, or maybe the government is also involved, a business is involved, you as a household or an individual is involved. So these are the three key pieces of the economy when you kind of go to a 50,000 feet view. Having said that, what had happened is uh, you saw labor layoffs, you saw a reduced footfall into the stores, which kind of centered out businesses. Government was not able to kind of collect as much of taxes because there were not much revenues, and that is something that kind of slowed down government revenues as well, right? And as we discussed, what was the impact on the household? One interesting piece that I wanted to share with you, how it also impacts financial services. So what happens is, let's say, maybe this year you wanted to upgrade your television, or maybe you wanted to upgrade your mobile phone, right? So you would probably either go to Amazon, or you probably walk into a local store and buy the latest piece of TV. And in many cases, you would have ended up taking it on loan, right? So if you take it on loan, there is a entire uh, as in back-end work that goes behind the financial services as an industry. You deposit money into a bank, that money is being used to give out loans to the needy, and the bank makes money by giving you X% of return on your savings bank or your term deposits, but taking Y% from having made that loan. And the difference of Y minus X is what keeps their business model running, right? So the household financial institution equation was that. The household trading partners equation is, as I explained, the way you go about it, the entire ecosystem, the retailer, the wholesaler, etc., etc. Right? So maybe if you were to go and buy it from your local kirana store, that local kirana store would have bought from a wholesaler. The wholesaler would have been stocking from either a stockist or directly from the company, right? So if there is a clog which has happened at one end, that clog just builds up through the entire cycle. Yeah. So these are ways which kind of got which kind of became hurdles for the economy to function normally, right? So what is now expected? What is now expected? How does the machine come back into action? Right. So this is where we'll probably figure out the various steps, as in the globally the banks have taken, or the governments have taken around it. Right. So probably on lockdown 1, on lockdown 2 and 3, and as it goes on and we go towards a more normal function, you would have started seeing more and more business activity being allowed, the ability for you to move around enhanced, right? And you started buying more stuff, or probably you started venturing out and spending into some of the things which were beyond essentials, right? And similarly, when it comes to the government level per se, you started seeing fiscal stimulus as one of the most important things India as a economy has done is direct benefit transfers, right? So at least monies were being transferred directly to the bank accounts of some of these households for them to sustain their livelihood, so with or without work. So that kind of at least kept moving the money from that household to taking care of the essentials in their house, and therefore the entire back end of that. Probably if you were buying, let's say, atta, then that atta required some milling plants to be active for the wheat to be converted to atta, which made the farmers active to probably go about doing their agriculture business as usual, right? So this is how everything is interconnected as a web in the economy, and small little changes here and there kind of opens up or rather kind of triggers the movements in the various machineries of the economy, right? So this is how things are going to get normal, and a lot of it that has started happening. Similarly, financial services, what you are seeing a lot of it about was the moratorium, right? So moratorium and the release of the moratorium, one of the important discussions that is currently happening in the economic world is Supreme Court allowing or rather allowing the waiver of interest on the interest, right? So a lot of things like these will now be implemented to bring the economy back into full-fledged recovery mode. So do we go ahead? So now let us see what has happened. What has shifted? So what has shifted is uh, basically a lot of things have kind of become essential for us. One of them is hygiene. I'm not sure when was it last when I would have gone and bought a lot of detergent soaps, a lot of masks, maybe um, uh, and if you see today, maybe even if you are using a big basket or if you are going to the local stores, you started seeing dadi ma ka nuska, immunity booster, etc., etc. So they have become an inherent part of our lifestyle today. And one other important thing that has happened, especially in metros and where people were dependent on a lot of this mass rapid transport systems, be it the metro, be it the local trains, be it the local bus services, or maybe the Olas and the Ubers of the world. And I'm sure this is something that people in Mumbai, people in Delhi, and some of the larger cities would relate to. The dependency has fallen drastically, and people have moved to their own means of transport, right? So today, even if you have to go from point A to point B, you would prefer your own means of transport, if at all, if you're required to travel, right? So this is something that has now become inherent in our lifestyles. On the other hand, the element of technology or virtual presence or the digital presence has become significantly higher, right? As against probably a movie theater, probably the amount of time that we spend on a Netflix is significantly higher, a Prime Video, right? Ordering food, maybe if at all, if you're ordering food, you'll probably be ending up going to a Swiggy and a Zomato rather than visiting a restaurant. So a lot of your activities which were probably requiring you to move your hands and legs are now restricted to you moving your thumbs, right? So this is how a lot of businesses have evolved towards making themselves more relevant digitally by being present in your mobile phones rather than being a brick and mortar shop somewhere, right? So what basically summarizes the new normal for businesses to how to conduct themselves is kind of in the block below. Contact as selling, the amount of digitization, the presence of digital version of yourself as a business has gone up. Downtime, as in processes have become more efficient, as in at least the way they want to conduct their business even in a physical setup is to ensure that you are not at a particular place for more than X amount of time, right? So a lot of queuing systems have gotten developed, and maybe pre-order or pre-book your slots, etc., etc. And obviously something linked to digitization is the e-commerce channels, as in more and more a mix of phygital, as they call it, a physical presence plus a digital presence, using physical modes of mechanisms to deliver or fulfill a demand. So for example, I'm not sure, but I have seen in maybe when GeoMart came through, or maybe as in even why GeoMart, let me make it very clear, as in a Bisleri as a distribution model did not have drop at home services, but I have seen them being very active at drop at home services. You can order for your Bisleri bottle from your laptop or from your mobile phone, and they come and deliver at your place. So which was probably not something which was as actively used as a service. And this links to a lot of strategic partnerships. So when I say strategic partnerships, some of the examples can be the cloud kitchen along with a Swiggy or along with a Zomato, right? So, and maybe you can look up some of these other versions, for example, the Urban Company, etc., etc. And then people started experimenting on new offerings. So when I say new offerings, you would have probably seen maybe brands like Savlon coming out with their disinfectants. Maybe a lot of these companies who were manufacturing alcohol shifted their capabilities to start manufacturing sanitizer equivalent alcohols, right? And there are probably different other offerings that you can probably think through. Maybe more packaged foods, ready to eat foods that started coming up in the shelves as against a lot of these other businesses they were into, right? Probably one other example as an anecdote I can share. This is again from my experience in Mumbai. Uh, some of these marquee restaurants, let's say the Taj Mahal, the Tata Group's Taj Mahal Hotel, maybe even ITCs, etc., JW Marriott. So what they have done is they have created platforms where you can order in food at your place from these locations, which you are probably not seeing even a single footfall during these past 6-7 months, right? So people have experimented around their core values and that have started developing around it. One of the other examples, again anecdotal related to this space, is providing COVID quarantine facilities. So you would have probably seen some of these hotels being converted into COVID quarantine facilities, and depending upon your requirements, you could probably use that particular setup as a quarantining facility for yourself. So that was probably not an intended use of a hotel, but this is as a case study evolved and they have gone about creating a business model around it. So with this, this is something which I have picked up from one of the larger consultants' report. This is in a way a slide which kind of quickly summarizes what is the expectations that the industry has around the pace of the recovery of these industries due to this slowdown, right? It kind of captures the pace at which it declined and what is the expected pace at which it is going to come back to, as in at least come back to what is a steady state, right? So medium impact and probably expected quick recoveries were the FMCGs. That is extremely evident, as in a lot of, as in we have not, as in this would probably fall in the category of essentials. Being at home, probably you have not stopped using a lot of your daily products, but you have probably gone up and stocked more biscuits, more chips, more cakes, as against what you used to do, right? As in being at home, probably you are snacking more often. This is just an example. I'm just using it in a light-hearted manner, but look at yourselves more closely. And I'm sure a lot of us would be stocking some of the items more than what we were used to in our households. Maybe the other vehicle, the category of vehicles there, you can again split it into two parts. One is passenger vehicle and the two-wheelers. Both of these have seen very, very sharp declines, primarily because there were no reasons for you to be traveling, right? And therefore, there was no reason for you to go and pick up any of these specific products per se. But then what has triggered and what is expected to happen is more and more self-mobility is expected. And therefore, what is going to happen is a lot of people will end up buying their own vehicles, maybe either a two-wheeler or a passenger vehicle. And therefore, it is expected that these are the segments which will come back faster, right? So if you look at the shape of the recovery, it's an extreme V. The drop was extreme, and so the catch up to the average will also be at a very, very fast rate. And this has started showing up in some of the data that probably if you are tracking, you would have seen two-wheelers pick up for the month of September has been very, very encouraging, right? So people are expecting that maybe by, if the seasons go well, the agriculture produces good, maybe December we'll see a complete recovery in the year-on-year growth projections around the two-wheelers vehicles per se, if not for the passenger vehicle, right? Similarly, I think I missed out on telecom. One of the interesting parts of telecom, okay, so there are two elements to the telecom. One is the current ecosystem, which is probably moving from maybe a 2-3 player to an extremely competitive scenario around Geo's presence, the plans that Geo has in the country. But having said that, in general, I'm sure you are spending a lot of time on your telephones, on your mobile phones, on the Wi-Fi plans being provided, right? So the expectation is this is going to definitely go up. And as and when people start moving back to their office setups, when the data is taken care by the Wi-Fi or the broadband being provided by or the office infrastructure per se, your dependence on your telephony or your telecom players will probably shrink. And so probably this has been a counter-cyclical industry per se, but maybe I will again disclaim the statement that there are other elements which are in play in this segment, right? Then we come back to some of these sectors which have had a hit, and it is expected that the hit will linger on for a longer period in time. I think these are mostly to do with travel, right? And especially for travel, leisure travel, something that you used to probably end up enjoying when in a vacation, right? So basic airline usage was mostly done for business purposes. So that has probably shrunk. Domestic, as in maybe for personal use, we will continue, but that will probably bring back the utilization of the airline sector to some extent. But having said that, it is not expected to be as high because a lot of people will either postpone their travel decisions or will end up being very careful around how they are going about their travel per se. And a direct impact of that is the hospitality business, right? So again, it is expected that the hospitality business, while it is expected to recover, it's probably not as great. Media has two parts in terms of, let's say, the public cinema halls versus the kind of content that was being showcased to you on TV channels. Because of the lockdown, you had seen a lot of content not being created, and whatever was the earlier content being used, or that kind of drops it down a little. But then again, when people go back to normalcy, it will probably be at pre-COVID levels. The decline was not as sharp, except for movie halls, probably a PVR or an INOX, as against some of these transmitters like a Sony or a ZTV, etc. Yeah. So with that, let us quickly, I think we probably have another 15-20 minutes. So probably we'll quickly touch upon, while I have tried to kind of summarize most of our thoughts into the previous few slides, let us look at how people have kind of adapted to the situation. One of them, as one of the primest examples, will be the consumer sector, which is again fast-moving consumer goods, FMCG, or any other service which kind of primarily helps you consume a service, right? So I had indicated to you liquor companies. So liquor companies have created ecosystems for allowing you to buy online and they're delivering it at your place. A lot of them have created some innovation around the packaging of it so that it is being made in a much more economical price point in an economical size unit, right? Similarly, for some of these well-established FMCG brands, you would see that they have gone for product extensions. So probably Lifebuoy has started a spray, Domex has also started a spray, etc., etc. Godrej, through their Goodness.me brand, has also ventured into a lot of these health and hygiene products. Dabur, if you would have seen, you would have seen them come out with a vegetables washing liquid, right? Just to take care of the requirements and and the scare of the virus being transmitted through what you buy from the markets, right? And then you had the Ordinal as a brand launching hand sanitizers. Marico again has set up a medical hand sanitizer, has also launched its own brand around vegetable cleaning. With this, as in some of these products which have kind of become stronger around the base that they had created, for example, a Britannia or maybe a Sunrise of ITC. So they had already been market leaders in their space, right? Or maybe a lot of these masala players, or maybe some of these, if you can say, maybe a Nestle ka Maggi as a product, right? So these guys have kind of strengthened their brand position because of the value that they provided, and these becoming more and more relevant in a stay at home kind of consumption, like biscuits, breads, more of Maggie, more of sauces, more of ketchups, right? So these kind of industries have kind of grown to their strength and have delivered better results. And then you saw the Swiggies and the Zomatos who kind of swept out a lot of these restaurant businesses, because you were not visiting a restaurant, you were to order through a Swiggy and a Zomato, as in they were able to generate more cash for being delivering from those same restaurants. And what one interesting aspect, as in probably you can look up, is the concept of a cloud kitchen. So a cloud kitchen doesn't exist as a brand in reality, but they create sub brands, and they are probably in some corner of the world with a fancy brand name, but their entire presence is through a app which is a Swiggy. So you'll probably not know how the cook looks or how the franchise looks, but you are happy with the product that they deliver, and therefore you are using them more and more, right? Just look up cloud kitchens as a business and you will probably relate to it better. Okay, so with this, what has happened on the flip side of the FMCG, you saw food products and the grocery products suffering a lot in terms of this lockdown, as in probably a lot of these kirana stores went out of fashion, which in a way, the retailing units, as in wherever there was an element of a mall or wherever it was required for you to visit a particular store to buy that product, experience that product, and therefore consume that product. I'm sure none of you would have gone out and bought a new kurta or a new pair of jeans or some new fancy office shirt, etc., or a tie, right? Or maybe shoes, right? Because these were requirements when you were probably utilizing them more in formal, semi-formal events. But today, if any one of you is picking up something, probably you will be picking up t-shirts, probably you will be picking up maybe track pants, etc., as against some of the formal products, right? So these are the industries. And probably one of the other trends that I wanted to highlight is the relevance of GeoMart in today's setup, the relevance of DMart. And DMart as a business has created a model of how do you put it, as in physical presence very close to your place. So you can probably order it online or pre-order it and then go and pick up your basket from their smaller little shop close to you in a neighborhood, right? Can we get going? Yeah. So one of the other segments which kind of significantly took off during this phase was the pharma sector. Within the pharma sector, again, you had seen a lot of these API manufacturers becoming more and more prominent, a lot of domestic equipment, as in hospital equipment getting fulfilled by domestic. As in one of the best examples of this is your speaker of yesterday, Mr. Alva, who runs the Scanray. As in they have seen significant amount of growth in their equipment sales in this period. Not only because of other reasons, but because they have become, as in this segment as a whole, has been given a thrust because of the Atmanirbhar Bharat scheme, right? As in wherein India as an economy believes that we have the capability to manufacture and fulfill the demand from the local infrastructure itself, right? So also at some point in time, we, as in the globe as an economy, was dependent on China on a lot of pharma. Even today, there is a significant amount of dependency. But having said that, a lot of the manufacturing setup has kind of gotten converted to 1+1. So which basically means in order to diversify geographically in terms of a manufacturing setup, people are looking at other options, I mean, apart from China or apart from wherever they were. So, and there are a lot of economies which are vying for that piece of cake. So it could be primarily India, but you see a lot of Vietnam, Indonesia kind of markets who are trying to catch hold of these opportunities. But having said that, India has been traditionally very strong in pharma, and that has started playing to our advantage. Some of the new initiatives in this process was that were taken up by the pharma industry were about the way they were packaging it, the way they have used the e-pharmacy and digitization. So probably on the bottom left, you will see some of these e-pharmacy plays. And then more importantly, you started seeing a lot of it moving to the way it is being uh, stored and transported across, right? The glass vials, so which are probably more safe and safe in terms of hygiene wise, right? So having said that, how has it impacted the e-pharmacy place? So if you look up, as in you have now probably seen the relevance of a Practo, the relevance of a 1mg, and the entry of Amazon into retail pharmacies, right? So today you can also order medicines on Amazon, which was probably non-existent, at least in certain geography, as in I think they have already kickstarted it in Bangalore and some few other cities. What also happened during this time is a lot of these e-pharmacy online plays that existed, for example, Pharmeasy or probably NetMeds, which were by default existing. There were maybe they were shifting, there were tectonic shifts happening in that space. So you saw Pharmacy acquiring MedLife, which anyways had also had Myra in its fold. Reliance very recently announced their acquisition of NetMeds as a platform in their Reliance Geo, the GeoMart platform, right? So in a way, pharmacies anyways have done significantly well, even the physical pharmacies, and there has been a shift of the retail pharmacy into the digital platforms. So again, one other sector which has done significantly well. Okay, so with this, as in, it is a reflection of how the pharma sector has performed even in the stock markets. It has kind of outperformed to an extent of 45% beyond the Nifty. The other part, the third element where I wanted to kind of highlight, which have kind of adapted or thrived in this circumstances, is technology, right? So as you would have seen in the recent newspaper articles, Mr. Mukesh Ambani was quoted to say that data is the new oil, and that in a very, very clear way summarizes, right, very strongly what is the impact that data has or the digital presence for us has in the today's context. And this is very evident the way you see this is something on a global scale that more and more companies are going digital, more and more companies are probably creating business models around technology as a delivery platform, right? So maybe 3 years back, you did not hear terms like education tech, medical tech, maybe agriculture tech, right? So today you have fintech, edutech. A lot of it is in colloquial language, right? So this was probably not the case as late as 3 to 5 years ago, right? So things are rapidly moving, and having said that, a lot of it is around businesses trying to becoming more and more relevant and being more and more in your face through either your laptop, through your tablet, or through your mobile phone. And this is what I am trying to say is an increased digital spending, right? So this in a way kind of summarizes where technology spends and the technology trends are emerging in this kind of a pandemic situation. And with this, what has also happened is the use of technologies as in not only for internet-based commerce, but technology as an enabler for running businesses in what is otherwise a traditional manufacturing setup. Okay. So maybe a use of more and more artificial intelligence around doing business, use of more robotics and digital process automation, using IoT, which is Internet of Things, around a lot of. Maybe you will start seeing your ability to probably cool your home from anywhere else in the world, right, before you arrive into the home, etc. So these are a lot of things which are kind of integrating instrumentation technology into day-to-day business cases, right? And as and when this becomes more and more important, you will start seeing a lot of it becoming an integral part of even your consumer electronics, right? Even today, if you recollect, if you visit any particular website, you have started seeing automated chatbots coming and saying, "Hi, can I help you?" etc. So look at it this way: every time a chatbot comes up and engages with you, it in a way is taking care of the necessity of having to maybe call center executive somewhere else, right? So a lot of it is becoming more and more interactive, machine learning and artificial intelligence driven, right? So just to kind of leave this slide with how the legacy systems and the new digital technology presence is going to pan out, as in you will see that the digital CAGR expected over the next 3-4 years is as high as 12% as against the normal legacy system. So normal legacy system means a banking system wherein you have to go, it punches something, or maybe your online ticketing system, or rather not online, your desktop ticketing system of a airline, right? So there will be a significant shift, and the movement will be significant. So now these are some of the sectors where there have been some hiccups that have been experienced. So I have already highlighted the importance of financial services. Within financial, let us kind of, for the time being, for the lack of time, let us ignore the left-hand chart. Let us look at only the right-hand side chart. Within finance as a financial service as a market space, you have multiple layers of it. Let's say wholesale finance, a microfinance, a SME financing, auto, as in basically your two-wheeler, three-wheeler commercial vehicle financing, your infrastructure financing, your housing and affordable housing financing, and gold loans or gold financing, right? So the asset quality outlook and therefore the health of that particular smaller subsegment of BFSI is kind of depicted to you on the rightmost red, amber, green kind of a highlight. So affordable housing and gold finance, primarily due to gold finance's ability, the gold price where it is today has kind of given it the support. And any time you are in a little bit of financial uncertainty, your household gold becomes a currency for you to have access to some kind of liquid money. And this is that business model, and therefore it has thrived. On the other extreme, a wholesale finance where corporate lending, basically pure play corporate lending. So when the businesses are going slow with a limited amount of cash flow visibility, etc., the ability to price that risk has become a little difficult, and therefore lending credit to that segment has become difficult. Is this okay, Pace? If you think I need to dwell deeper into it, you can question around any of the other segments, but for the paucity of time, I'm generally kind of going ahead. Is that all right? Okay. So I think this will be amongst the last few slides. The most hard-hit sectors, as we had pointed out in a previous summary slide, is basically a lot of things to do with your travel and hospitality, right? And maybe a lot of it is also to do with your discretionary spending, right? So discretionary spending would also include you going to a water park, you going to a probably a longest vacation, or you planning to buy a high-end phone for the sake of it, right? So a lot of this discretionary spending requirements would have gotten curtailed as a household, right? So as I had explained earlier, some of these things, as an Urban Marriott Wheels, all of them have started picking up. Having said that, some of these airlines have put their infrastructure to good use by using it as a freighter services, or for example, your e-commerce delivery point-to-point linkage systems, right? So that is how they have kind of adapted to the current business. And as I pointed out earlier, entertainment as a business has gotten replaced by Netflix, Amazon Video, and you have seen some of these large, high-budget movies getting released on these platforms, right? So in a way, what I'm trying to kind of summarize is that every business, to an extent, has gotten impacted, and they have found out ways and mechanisms of kind of surviving through it till normalcy comes back. And with this, I think a quote of one of the greatest leaders India has seen, as a philosophy, you should not give up and you should not allow the problem to defeat us. So let's see how we recover from the current pandemic situation. I'm extremely hopeful, and I'm sure that within the next 2-3 quarters, things might become normal, and this will be kind of catalyzed faster with the development of a vaccine and it being made available to all of us. So thank you once again for your time. I'm open to any questions if you have any.
Sir, you have few questions.
Yeah,
The
please.
first question is from Dr. Purushottam DN. He has asked two questions.
Yes, please.
One is, why are successful ecosystems so rare?
Okay.
And the second question is, why do most business ecosystems fail?
Okay, so these are extremely interesting questions, and they are actually linked. Um, if I can, as in, sorry for kind of dragging this analogy a little too far. Um, um, the probability of the human being as a species to exist is so low, right? But we have kind of created a space for ourselves in this ecosystem, right? So the point is, there are so many factors which kind of are involved to get us to where we are, and that is true for even business ecosystems, right? So keeping the philosophical side aside, to answer doctor's question, let me make it slightly more simpler, right? So for an ecosystem to survive, there are a couple of elements that are extremely important. First element is probably the ability to maneuver through uncertainties around what you have, right? So having the nimble footedness to quickly change around a lot of things depending upon what situation you are in. The second part will be probably having, as in for a business as a unit, ultimately business as a unit also depends as to what kind of leadership, what kind of direction setting that you have in place, right? So the ability to have a well oiled mechanism which focuses purely around execution, and execution being as important as the strategy is. So that is again another important aspect, right? And three, obviously, the ability to have the capital on your side. So maybe this is an element of finance into it, but you may be having a brilliant idea, but not having the right capital at the right time, you probably may not be a success. So there is, okay, so this also brings in an element of luck. So maybe yes. And this, in a way, these 3 points, in a way, are also linked to his first question as to why is it rare. So for all these three things to happen together, as in there are certain things which is within the scope of an entrepreneur, or of of an economy at large, or of a policy making body at large. Uh, so the ability to have the maneuverability around the existing resources and the ability to put it to right use and making the most out of it is an element of not only good fortune but also an element of good thinking, right? So because of these three aspects or some of them not being available at the right moment, probably that leads to a lot of failure. Or I would not say failure, but a lot of them falling off that track, and probably at some point in time they'll come back. But as of now, they probably do not deliver to their promise. Is it a satisfactory point, sir, or should I elaborate?
Another question.
Yeah.
From Ms. Malini.
Yes,
Any
please.
suggestions how these affected areas can get to normal?
Yeah, okay, so it's a slightly generic question, Malini, but let me address you in a slightly, again, it probably will not be specific, but again, generic. So what happens is a lot of us are, when I say a lot of us, it basically means a lot of advisors, a lot of this policy making bodies, a lot of this self-industry bodies, right? So you have FICCI, CII, etc., who understand very well how the businesses operate on the ground. They understand very well what have been the technical challenges for each of these businesses, right? So they are able to relay their demands and requirements to the policy making body, and obviously there will be some element of hand holding that will be required at this stage, providing some kind of stimulus directly or indirectly to some of these businesses. For example, you have seen some of these agriculture related requirements, or maybe I think more than that, you would have seen financial services as an industry being helped around directly or indirectly through a lot of these policies and stimulus, relaxation of some of these taxation requirement, extension of timelines around some of these payments, etc., etc. So in a way, see, it's very simple. As in, I will put it slightly differently. As I pointed out, a economy is a giant machine with a lot of small gears interlinked to each other. If one fails, it has the capability of bringing everything to a standstill. But having said that, if you slowly turn that wheel, it also over a period of time will be able to go back to its top speed, right? So maybe from a 50,000 feet view, you will probably not be able to make out, but a closer look will probably let you realize that, okay, by taking care of this small little aspect, I can probably make big impact. So I'm 100% sure, and maybe at a district level, at a state level, at a central level, maybe globally, there are a lot of policy actions that are being taken around it. And more importantly, what we can also do, contribute to our little ways, as in probably you step out and purchase some of this local produce, probably take care and start giving out small little errands to maybe paint your outside wall, wherein you are not risking your family, but at least in a way providing employment to some people per se, right? So certain little things that we can do, and certain little things that the policymakers will decide. Yeah. Does it answer your question? If you could ask me any specific sector, probably I can help, but this was a very generic response.
Yeah, sir. Only these questions were asked.
Sure.
So thank you for your valuable time and your informative presentation.
Thank you very much. Thank you again, all of you, for inviting me and allowing me this opportunity to share my thoughts with you. It was extremely pleasurable experience to have spoken to you guys, and very, very inquisitive questions. I hope I have answered them. If you want to engage better around these questions, please feel free to write to me, and then you can probably, I think, Ms. Pinto, you can probably share my email ID to anyone who would want to ask questions or engage further around this topic. I'll be very, very happy to help. Thank you so much.
Pleasant day to you all. I, Irene Marie Dove, take this opportunity to summarize the events that took place today. The first session was on climate change and credit risk management. We had Professor Rudiger Kizel
who spoke on how European countries and other developed countries monitor companies to control carbon emission. His highlights on Paris Agreement, Summit, and Clean Development Mechanism also gave a thorough insight to the participants. In the second session, we had Mr. Subrat Panda, who vividly described the various aspects of the impact of the pandemic to business ecosystems, how various sectors have gotten affected, adapted, and thrived amidst the COVID-19 times. He also emphasized on the upheaval happening across the globe, adapting to the new normal scenario by citing a lot of real-time examples. I hope you all have gained ample knowledge through these sessions. Thank you all for your active participation. We will meet with other issues of commerce and management like FDI in India and post-COVID market condition in India at 4:30 p.m. tomorrow. I request all the participants to kindly fill the feedback form posted in the YouTube chat. Thank you all. Have a pleasant evening.